What's going on, guys? Jeff here, Mitt PV, the best REIT voted by our parents in Ontario, is here right now. We had a very interesting summer where most people take the time off. We have some strategies from all our traveling around Ontario, seeing the buildings, and our investors are going to be quite pleased.
I guess the beautiful thing about our fund and our strategy is, we execute the value add strategy. So with that strategy, you're aiming to improve the net operating income of the building, which then improves the value of the building, and hence will pay our investors a cash flow distribution, but that's what also causes the unit appreciation in the share price. So, with our strategy, whether you're in a hot market or a bad real estate market, as long as we're doing well on the buy and buying the types of assets that have the potential for us to increase the net operating income, we can execute that strategy in good times, medium times, and great in bad times as well. So as long as we're doing our job getting good deals, not so much of a concern. So on the flip end, yes, if rents are down a little bit, end value that we can push these properties to may decrease slightly, but if we're buying them right, there's still a lot of juice and return to be made. So I think that's a key thing for investors to note.
One of the big things is obviously the asset class that we focus on is older buildings that we're renovating up to brand new standards. The people who are moving places right now, they're just taking advantage that rents are down to move to a bigger place, because our tenants are typically new grads, new to Canada. They're in doctor, nurse in training, or engineer in the area, and they need a nice place to live, but they don't want to blow the bank, because in the areas that we're in, there's all these new builds, there's other available rental options. Those were going for, let's call it the $2,400 to $2,800 in rent a month or more. That's where we've seen the market actually pull back, even though we've had turnover on our portfolio as well. In April, it seemed like, where the heck is the market going to go? Our units have actually filled back up to, I think in the London market, almost 100%.
Mm-hmm.
And the only time we're seeing a vacancy or some an empty unit is when someone's moving to go to another place, or they're moving out of the town for a job. But I think, guys, wouldn't you say we've been filling them up pretty fast within a 30-day kind of period?
We got our rental agents working overtime. With PV, you're saying the net operating income, money in.
Exactly. How much does a building bring in? What are the expenses and what's left over? So in a nutshell, what's the net amount that this building is going to make? And that's what drives how much is this thing going to be worth.
And I think for our buildings, because we're refurbishing older stuff, our rents are still on the lower tier of the market, but for a premium product. Mm-hmm. So we're able to keep the buildings full at all times. It's kind of the advantage that we have with our investment plan.
Yeah, I know some people have questions about how the appreciation works in the company, because obviously there's a 7% distribution of a cash flow, and then we have the 8% plus is our targeted appreciation.
Yeah, I think in the most simplest way to explain it is that appreciation comes from how much we're able to increase the value of the buildings that are in the fund. So, the more we're able to increase the value of the buildings in the fund, that not only allows us to meet that 8% appreciation, but potentially even beat it. And then on a very simple basis, the more income we can make the buildings make, that's what's going to drive that appreciation, or how much the buildings go up in value.
So I think to add to that, as rents go up, the building values go up. So $100 increase in rent is an increase in $25,000 in building value. $100 a monthly increase in rent is $25,000 in value. So as you know, guys, we're buying buildings that typically the lower paying tenants would have rents anywhere between $600 to $800 in rent. When we turn it over, it's going to $1,500, $1,600 a month, all the way up to $1,900 a month, $2,000. You're seeing over $1,000 or $1,000 or more a month. So that's $250,000 in top level growth on just one unit. So you have building value goes up $250,000, and then you basically take building values minus the amount you owe for mortgages, minus any other bills you owe, and then divided by the number of units outstanding. That's how we come up with the share price, and we kind of always assessing it on an ongoing basis. And we know what it is or where we're going to be landing based on those turnovers or, the vacants, like people leaving to say they're moving out of town, we got a new unit, we're re-renting it, it's going up $50, $100, or we're taking existing units, splitting it into two, and now we've got, an extra $1,000-something in income. That's how we're driving that value. And so we know how to push that building value up. And that's the main driver of how we create that share appreciation, which is what sets us apart, again, from the other REITs out there that typically will just wait for somebody to move up.
And like you said, if you do it for one unit, that's a $250,000 increase. Let's say we buy a 20-unit building, and in the first bit we're able to turn over half, which is 10 of the units. Boom, that's 2.5 million in equity that we've created, and then we're obviously going to continue to try to get the remaining units turned over to maximize the shareholder value.
Without going into like the complex math of things, from a rent perspective, everyone says, Mitt, PV, Jeff, like rent, you can only increase 2.1% annually on some of these buildings, right? How are we going to make that 8% return? One, the equity that we invest into a property is leverage. So we're getting a loan for the rest of the amount. But that 2% from a mathematical perspective, usually your expenses on the bottom level are only about 40% of your overall total rents. So your net operating income is about 60%. So that 2% typically will translate all the way down with very little change in expenses. But for our purposes, we even assumed a 5% increase in expenses across the board, which again, that's not what we normally see on a year-to-year basis. That on a 12-unit building will automatically create anywhere between $50,000 to $90,000 in value just by doing your standard rent increases. That's why for a lot of our other competitors out there, it's easy to provide, like, say, a total return of 7%, because they can easily hit a 3% appreciation just by doing your standard rent increases, and then just pay out distributions or cash flow. For us, we're able to get that larger plus appreciation amount by getting those turnovers.
Some people, and we're obviously talking about Ontario right now, and different markets come up as well too, like Saskatchewan, Alberta, Ohio, Texas, Florida. Go somewhere else. Ontario is not landlord friendly, but that's kind of our bread and butter in Foundation Capital, where we're aware Ontario is not landlord friendly. However, with these strategies that we are executing on, we're able to access this equity for our investors by hard work, turning the units over, renovating them, renting them out for top dollar. Whereas everybody else, they're looking, we're going to go to these more cash flow cities of Ohio, et cetera, go to America, Canada, this and that. But obviously we have over 250 Canadian investors trusting us in our product right now, and we're able to get appreciation, whereas some of the other markets is just more of a cash flow market, right? So we have the best of both worlds, cash flow and appreciation.
It's funny you say that, Jeff. I guess you could equate this into sports, right? Like you can go play in like an all men's league and be the most dominant player, playing hockey, or you try to go to the NHL, and if you can withstand the NHL, you're getting paid like a nice salary, you're getting good money, you're getting sponsorship bonus, all that stuff. But it's competitive level of play, and you have to really grind it. Not everybody makes it. Most people fall out. Most people fail.
Think of the hard things. There's the landlord tenancy board. You see all the news articles. This tenant owes $20,000. We have that too.
Yeah,
we have that across an entire portfolio, not in one duplex or one condo in the middle of Toronto. So we're able to send paralegals after this, and it's just part of daily operations that we're executing on this for our investors to get access to this appreciation and the cash flow. Pretty proud of that. But obviously that's our grind, boys. We're a little bit, if you're just new here, we're pretty obsessed with our portfolio and micromanaging things to an extent, and things are flowing now, but obviously we know that there's a leak going on in this unit, and we know that this tenant's coming up for rent, and we just know that
part of it is also like we like to stay involved so that we know how to be able to generate those additional returns. And I guess
leads into the field trip, right?
A major difference between us and other fund managers is we do like to take a hands-on approach when it comes to managing the units and doing these scheduled field trips in order to see boots on the ground, what's kind of happening at the buildings, see if there's anything that's slipping through the cracks, and just making sure that we're having like a holistic view at everything. So, the field trip was very interesting for us, just walking through the units, seeing the potential. And I guess I'll give it to you guys to go into the development stuff, but having a plan in place for how we want to move forward on certain units that have already been turned over. Do we want to go ahead and rent these right away, or do we want to go into our new strategy with these and see what the potential returns for the investors could be?
You guys obviously are in the spreadsheets daily, but going down with the spreadsheets, so boots on the ground and spreadsheets, is just so valuable, because we were looking, some of the cities that move away further from Toronto, I don't know what was happening in the 70s, but like square footage wise, must have been so cheap to build, because you look on a spreadsheet and it says 1 bedroom, and you look on a spreadsheet it says 2 bedroom, and you see the rent, but the price per square footage is a lot different per city. So that's the nitty gritty we're kind of getting into now, and which kind of leads into, all right, well, if there's this giant 2 bedroom and it gets the market rent of a 2 bedroom, what if we chop this up a bit to spend some capex, renovate them into 2 1 beds or 3 bachelors, and all of a sudden we're pushing that NOI up, the money in versus expenses out.
25K value increase on $100
is going to just boost the values for the investors there. So yeah, so we're looking at these units and we're like, we can create more. So it's obviously going to be creating more rental supply for the market. We couldn't have got that without going down there. So we're now all of a sudden like, okay, once you thought a building was done, it was all renovated, nice hat, and the investors are like, well, how are you going to increase value now? Foundation capital. And it's like, well, we got some new ways now, and it's not just a vending machine at the end of the hallway.
Yeah, no, for sure. I think, and it also comes from perspective, right? I think we're all pretty well traveled here, and we're able to see the other parts of the world and see where immigration and what people are used to, especially in like larger cities. And we're seeing that, there's a continued demand for rentals. It's just, and when people are saying there's high vacancy, that's more in the luxury rental market, or in the stuff that is over $2,500 plus. That's where someone who's making like $25 an hour, after taxes, at best they're taking home $2,800 a month, right? Like, they can't be spending the entire salary of that just on like rent. And so they look for what are those other options. And what we've noticed is, like, for a lot of people, like the 1 beds to 2 beds are very close, $1,500 to $1,800. But if you look at the luxury side, the 2 beds are like $2,400, and they're like, no, I'm just not going to do that. To where people are even just renting out rooms, right? If you look on Facebook Marketplace, Kijiji, it's a very more normal and common thing now that we're seeing, where people are like co-living together. So that's where, obviously, that's popular in other parts of the world, like whether that's like the UK and other parts of Europe. People co-live together to basically save costs. And I think, we don't necessarily want people to be co-living together in rental units where they don't know each other and having to micromanage those relationships, which is why we are going towards those bachelor style units where you still have your own space. You've got like in-suite laundry.
Lock your door. You got your kitchen.
You lock your door. You got your own spot. And then this way you can save up money so you can have a down payment towards being able to buy a house. To have a home, to be able to live with your family in a decent place. So it's been pretty exciting. I would say, like, I think for all of us, when we were walking through, we were like, holy crap, when
these places are huge. Yeah.
These tenants had all their stuff in there, I think our eye, with our visual perception, we're thinking like, this unit's way smaller, like it's not fitting. And then you go in and you're like, man, this is a huge 1 bedroom apartment, like.
Yeah. And it's interesting if anyone's stuck around this far in the video, but now when we're looking at other buildings to purchase, we can start thinking about this kind of stuff. Whereas someone wanted to buy one of our buildings, and, they're just generally running the spreadsheet numbers based on what it says, and they don't understand about this value add. And maybe this will be our competitive advantage for the next so many years, and spilling the beans here later in the video. So hopefully our competitors don't see this, but an additional on the walkthrough, guys, I've always wanted to do this, but the market's catching up to it now. which, so now it makes sense to do it. But the boiler rooms, the storage rooms, not necessarily the boiler room, but like adjacent to it, there's the dead space. There's like laundry sinks and all this stuff. This is living. This could be another living space in Ontario right now. And we're going down permits with the cities and seeing what they'll allow. And it's like, yep, go back to what PV said, get the rent up. So here's some square footage that could turn into a rental unit. And we'll add an extra $1,000, $1,100, $1,250 per month for these apartments that we're going to create for the market. And we staring at the spreadsheet all day, we're never really going to see that until you go down there, bring our construction guy down, and we're like, yep, we could just move there's a sump pump here, but we'll just push it over here. And like, that's all I need to know. And then now we go back to the drawing board, talk to the cities, and we're like, all right, well, what will this cost? Yeah. So that was just so fascinating to go down there and see that. And I think we just full of excitement coming home down the highway, and like me and Mitt went live that night at my house on Instagram, and we're just like so pumped about the future of Foundation Capital for current investors. And again, future investors, hop on, because it's a wild ride coming up.
For sure.
Yeah.
Another cool thing was, we all hear the tenant issues and headaches, which we actively manage on a day-to-day basis. But, being there at the buildings and seeing, okay, this is this problem unit, or this is the one where we had the crack den infestation happening.
Oh
and
my God.
That was kind of cool to see, especially, given that we've resolved it now and dealt with those problems. But these are assets, but they come with real stories and real people. So it's always cool to see that.
Yeah, we're gonna have to do our own podcast one day and like sit around fireside chat all in the same room.
Yeah,
just go over these, not say any names, but like, we got stories, guys. Murderers to fires to this. Like, I don't think anything really phases us too much anymore.
And I think it's funny because we've been so used to the stories now, to the point where, like, our job is to deal with these headaches and issues,
and
make sure these properties make money for our investors. So we kind of like put it away and we're like, all right, problem resolved, and move on. But realizing a lot of our investors actually want to hear these stories, and
it's probably just like,
through us.
Okay, good. These guys have it. I make my money. I want to know about it for the comedy, but I never want to have this in my life ever, because you guys do not need these calls on Saturday nights and and Sunday my kids are in the pool and me and Min are like solving a flood. Just that's not why investors passively invest in Foundation Capital. They like their returns.
I think for a lot of them, as like we probably talked to them on our investor calls, right? Like, most people who are investing in our fund have been previous real estate investors themselves, or own real estate investments themselves. And they're just tired of the headaches, right? Like, one thing that never changes is that, like, even if the economy's down or whatever, tenants are just going to be at home more. The complaints just start increasing. Now they're trying to be nitpicky. They're trying to get out of their leases early and stuff like that. And they're like,
oh yeah,
I just need a rental agent, and now they're gonna break it.
They don't talk to us face to face like this, but they like to do that behind the scenes. It's kind of like calling Rogers Cable and just bitching about the modem or something like that.
Our investors are having to face with these issues, right?
Yeah,
like, they're just tired of having to hear them.
That is one of our top avatars. Is like, I owned property. I'm just done with this at the low level of duplex, triplex, because you have one of these problems in a duplex. You have 50% vacancy all of a sudden. That sucks. And you're taking your own money to go pay for your investment. All the big stories on CBC, like, my tenant owes me this and this. Yeah. So a huge avatar for us are those people. And obviously, one of the things I like to say on the investor calls too is, what's your goal here? To be the Ontario's greatest landlord, A, or B, make money? And when I kind of like put it like that, or it's like, do I want to be the world's greatest real estate agent, or do I want to be the richest? Like, what that's kind of all of a sudden yin and yangs with investors. Like, you're right. Why am I going to classes about how to be the great landlord and make a care package for my tenant? Like, that's great but if you could eliminate that and just make money, I'm sure you would go that route. So many people are taken over by this, and it's like Saturday night, you're out dinner with your wife, and a tenant's like, I'm locked out, and you're like, I'll be right there, because you're so low,
I translate that actually really well to maybe when you do flips, right? Like my problem when I did flips is I would think that I'm the end user, like I'm going to live in it. So I make sure
over
everything's
renovated.
flipped and nice, and that's why I'd always overrun and lose money on flips because I just go overboard. And that's what people do when they only have one or two rentals, right? Like they don't really have the system in place. They're dealing with every single thing running around, be like, oh, it's got to be like my house, or exactly how they'd want it. But at the end of the day, it is a rental, and what they don't know, and what I find funny is like when you own your own home, a light bulb goes out, you figure out your light bulb.
Yeah.
Right? Some you YouTube it, you try to problem solve some of your own stuff, and sometimes tenants don't do that, and
no, it's easy to just message the landlord and they get your cell phone and you're like, I have one rental. Now I'm like a hotel concierge service to this tenant. And it's like, wait, go back to the flow chart. I was doing this to make money. And some of our top avatars are ex-landlords. So like they've sold their triplexes, they've netted 250K, and they just took their 250K, invested with us at 15% plus targeted annual returns. And it's like, yeah, that's a lot better than just because when are you going to ever see your money from your rental property? When you liquidate, when are you cash flowing? Probably not, because a fridge goes down, a stove goes down at least annually. Like if you have like a duplex, triplex, something's going wrong in there. An appliance is going down, a flood's happening from unit 1 to unit 2 at throughout a year. It's just happening. So yeah, they kind of realize, yeah, maybe I should just liquidate, give it to you guys, and enjoy my life. So that's been great for us when people trust us with their cash, which we're obsessed with to make them the returns.
They get the benefits of owning real estate without the headaches and the sleepless nights.
It goes back to the flow chart. Pool your money together in the REIT with us, and obviously we'll be able to execute on the returns for you guys.
Yeah, I think one of the things as well is like, guys, we do have a 2% bonus right now until August 31st. So get your investments in. You get a 2% bonus on the amount that you would invest additionally until then. And then we're going to be assessing the valuations and doing a price adjustment as well. So that's kind of what's coming up in regards to that. From a fundraising standpoint, I'm sure you guys have seen, we've been doing a bunch of if you're not being targeted on Facebook, let us know on Instagram. But we have new video ad sets and stuff that have gone out from a marketing perspective.
Been talking to a lot of new Canadians that don't know our product. So,
and if you're not getting the newsletters, shoot us a message on that kind of stuff as well. I'm trying to keep you guys informed through our Instagram content. So like, feel free to reach out to us. I think we want to be pretty accessible and be there. Like if you're an existing landlord or like even a business owner, I think one of the calls I did specifically was tax planning on how to, use money from your corp to be able to invest. Or if you're thinking you're going to be able to invest later down the road, you just want to have some guidance on what to do, just feel free to reach out to any of us. I think we'll be able to help with that. And yeah, like Jeff was saying, we just spread that risk across because there's a large number of units in the fund. So it's not just a duplex with 2 units. It's being spread across many, many units.
That's huge. All right. Hey, boys, we'll do this more.
All right.
Okay. Back to work.
Thanks, guys. Thanks.
Bye.